Hi, I'm Kevin Gallagher, Pardee Faculty Fellow and co-chair of the Pardee Task Force on Regulating Global Capital Flows. We're gathered here at Boston University at the 65th anniversary of the International Monetary Fund and when it started its operations. And we're here to launch a new task force report, the Pardee Task Force Report on Regulating Global Capital Flows for Long-Run Development. It consists of a number of essays written by scholars and policymakers at a workshop here at Boston University in September of 2011. We were tasked with examining the extent to which nations need to regulate global capital flows for long-run development. One of the core messages of the report is that we need to go back to those original IMF days to a certain extent, because the International Monetary Fund's Articles of Agreement gave nations the ability to regulate global capital flows, to monitor and enforce them, and to coordinate and cooperate with them at a global level. The Brazilian president, Dilma Rousseff, was in Germany this week, and she referred to the proliferation of cross-border capital flows in the wake of the financial crisis as a tsunami that needed to be tamed. Why? Because we've got low interest rates and very low growth in the industrialized north, and high interest rates and relatively faster growth in the poorer countries. Therefore, investors are pulling money out of the rich countries and speculating on developing country currencies, stock markets, bond markets, and commodities. This is wreaking havoc on the long-run development prospects of many developing countries. Appreciating exchange rates makes it harder for exporters to export their products abroad, and it can deindustrialize a country, and industrialization is a key component of long-run growth. Stock and bond market bubbles can cause asset bubbles like those that caused the U.S. crisis here in the United States in 2008, and commodity speculation can hurt the most hungry in a country's population. We argue that in the wake of the global financial crisis, it's important for capital to go towards more productive employment-based investment and investment that will sustain rural livelihoods across the global south. One of the key components of such a strategy are what we call capital account regulations, or regulations on the flow of global capital flows across borders in the world economy. Some examples of those are the 6% tax on short-term debt that the Brazilian president put in place to try to tame this tsunami. Another example is the fact that countries like Indonesia and Taiwan make investments stay in the country for a certain period of time so it doesn't flock out when things don't look as rosy as they did when it came in. Other examples are Vietnam and China that have outright restrictions on the ability of countries and investors to invest in their stock markets because they just don't think that the stock markets can withstand the massive inflows and outflows of capital into their countries. We've got three members of our task force presenting this afternoon. First, we have José Antonio Ocampo, the former finance minister of Colombia and now the co-president of the Initiative for Policy Dialogue at Columbia University. He's going to talk about the core rationale for capital account regulations in the wake of the global financial crisis. Then we hear from Dr. Ilene Grabel from the Korbel School of International Affairs at the University of Denver. She's going to talk about how a host of emerging market and developing countries have been using capital account regulations and really expanding the new flexibility in the world economy to tame global capital flows. She'll also stress how important it is for nations to fine-tune these controls so they stay ahead of markets and prevent the evasion of capital account regulations. Finally, I make a case for the need for international cooperation for capital account regulations, but show how that's getting a little bit more difficult in the world economy. In terms of international cooperation, right now the burden on governing capital controls has been on the capital inflow recipients. So a country like Brazil that is the recipient of a lot of speculation on its markets is putting in force measures that are trying to combat problems that are occurring across borders in the United States and Europe. That's why the president of Brazil has been in the United States and in Europe asking these countries to reduce the speculation that comes from there. There needs to be cooperation across borders to deal with these flows. The Articles of the Agreement of the International Monetary Fund created a lot of policy space and flexibility for that. And in fact, many nations throughout the 1940s, 50s, 60s, and 70s did cooperate on that kind of a level. Starting in the 1990s, however, there started to be a web of international economic agreements, such as the OECD, the World Trade Agreement, World Trade Organization, and a number of free trade deals. And these deals restrict the ability of nations to govern capital controls. We have a couple core recommendations at the end of the report. First, we make it clear that capital account regulations are essential tools for countries to regulate capital flows that shouldn't be used as a last resort and that should be coordinated between developed and developing countries. Two, that there's a real role for the International Monetary Fund and other global financial bodies to help monitor and enforce different rules across the world economy. And third, that there needs to be a conversation about this somewhat inconsistent web of global treaties where you have, on the one hand, perfect flexibility to govern capital regulations under the IMF Articles of Agreement, but different trade treaties make it much more difficult. This task force report was a multi-university effort. In addition to Boston University's Pardee Center, it was co-sponsored by the Initiative for Policy Dialogue at Columbia University and the Global Development and Environment Institute at Tufts University.
I'm very glad to be here today launching this report as we were last year in this very fascinating discussion that we had on this issue. So let me start, complementing these initial remarks by Kevin with a simple observation. I mean, there is a clear recognition that the current crisis was the result of mismanagement of finance. And therefore, that part of the effort that has to be done worldwide is to re-regulate finance. Now, and that task, the G20 took upon itself to do that, the job, and they have done something, you can say insufficient, but, there has been some advance. But one peculiarity of that effort is that they forgot about cross-border finance. It doesn't show up anywhere in the G20 work. So it's almost as if it were no finance. That somehow, finance, if it's national, it has to be regulated, but if it's cross-border, there has to be nothing to be done about that. And that's exactly what, we're dealing with here. And actually, it has been, very fortunate that the International Monetary Fund actually has taken upon itself to analyze this issue and has made some contributions. We have positive and negative views on that, as I'll point, and all my colleagues will also point out. And the second issue, which is interesting, and this is actually a long-term observation, having been not only a student and an analyst of this issue, but actually a practitioner when I was in government, because we used some of these instruments very actively, actually, in the 1990s in my country, Colombia. But it's also that when we refer to this form of regulation, we always use the word controls. So these are capital controls, okay? Which is a very peculiar twist of language, and there are many twists of languages which have a deep meaning to it. And this is one of them. Somehow you want to say, well, yeah, it's controlled. You have to, be careful about, they are not very good. You can regulate but not control. Actually, sometimes people say, well, it's because, there are some prohibitions, et cetera. Those are controls, and then there are regulations, which are, let's say, use the price instruments. And there is, in fact, a division between, you can say, quantitative capital account regulation and price-based capital account regulations. Quantitative regulations are, for example, when you prohibit certain flows. I mean, as was typical in the past. For example, you forbid domestic residents from investing in foreign funds, which was a very typical pattern in the past. Or you say only certain type of firms can borrow abroad, or foreign investors cannot do certain operations with domestic banks. I mean, those are typical sort of quantitative sort of regulation. And then there are price-based regulations, for example, the taxes that Brazil has put in place, or the ones that we use in Colombia, which are called unremunerated reserve requirements, which basically you put anyone who borrows abroad has to put, depending on the conditions, 30, 40, 50% of that money in the central bank as a deposit, as a reserve requirement. Now, it just happens that, it is, I mean, the distinction that way is actually wrong, because all forms of financial regulation like that. They are quantitative based and they are price based. There are cases in which you actually forbid institutions to do certain things, and they are called regulations nonetheless. The Volcker rule, for example, is one of those cases now. Okay, so nobody calls that a control. It's really a regulation, as other forms of regulation. So the distinction is really semantic, but it has really a deep feeling to it. So, and actually that's what the word regulation is here in the name of the task force, to imply that this is a normal type of finance that generates all sorts of problems and therefore has to be regulated as many other types of finance. Now, what is the particular problem that we are dealing with? The fact that finance is procyclical. That is, you tend to have too much during good times and too little during bad times. Okay, but capital flows for developing countries in particular are strongly procyclical. It's not only for for developing countries. It's actually for many. For instance, for households, for poor households in a rich country, it's also very procyclical. Or for small and medium-sized enterprises, it's also very procyclical. By the way, when we're talking about cross-border flows, we are particularly concerned about developing countries because those are the countries that tend to have a lot of procyclicality in financial flows. And you actually, it's interesting that now you can even say that there is a growing family of developing countries that have been facing this problem. And there are the very well-known cases of the peripheral Europe. I mean, if any country has had procyclical finance in recent years, it's Greece, right? Which had a lot of capital, and then there is a sudden stop in financing, which has affected them severely, okay? So now, in those cases, the basic problem is that this procyclicality, is excessive flows in some periods and a lack of flows in others, generates a business cycle, and actually sharp business cycles. But even more, limit what governments can do to mitigate that problem. So the fact that you have those sort of patterns of finance, which actually have become even sharper with time, as a report from the IMF last year showed in one of the World Economic Outlook that analyzed the pattern of capital flows, actually showed that volatility of capital is actually increasing worldwide. But at the same time, that generates more limited space for developing countries to undertake policies. Why is that? Because, for example, you are in a boom. You want to slow down the economy in order to avoid an inflationary spiral, let's say. So what do you do generally in this country, in any country? You increase interest rates, right, to cool the economy. But it just happens that if you increase your domestic interest rate, what you are actually is encouraging more capital inflows. So rather than trying to cool the economy, actually you are overheating it by doing that. And you can go policy instrument by policy of traditional policy instrument by traditional policy instrument, and you actually find that under those conditions they are likely to be quite counterproductive. And that's why just attacking the source of the cycle, the source of the boom and bust, is probably one of the ways to go. In fact, according to some principles of economics, you should actually tackle the source of the problem, okay, and try to avoid the boom-bust cycle in finance directly. That's what capital account regulations are about. I mean, that's a basic rationale for capital account regulations. There's a long literature on the modalities of those regulations and the effectiveness of different regulations. And let me just briefly summarize them actually in 4 statements. First of all, there is a significant evidence now increasingly coming from the IMF itself that they can work, okay? And there is, and they can work in both booms and busts. I mean, in booms you want to restrict the inflows of capital. In crisis, you want to restrict the outflows of capital. So you may want to do both in different phases of the business cycle. But of course, at the same time, the private sector tries to circumvent regulations. This is as they try to circumvent taxes, right? Any form of state regulation, this private sector wants, somehow to avoid the full effects of it. So you have to be, the authorities have to be very careful, trying to find the loopholes in the regulation to try to avoid, the regulations being ineffective. So it's not that, some people say it's a leaky umbrella, but still the leaky umbrella can help, in a rainy day. Now, the second is that the effects may be temporary for that same reason. Now, the fact that they may be temporary, or as I call them in a paper, they are speed bumps, rather than permanent restriction, doesn't mean that that you should not use them. It actually means that you have to be very dynamic, trying to see what is the problem that is being created to try to avoid in the second round. Third, there is overwhelming evidence, and I think this is probably the major focus, the major consensus, that they improve debt profiles. They are particularly good at restricting more volatile kind of flows, and particularly short-term flows, so that even if they don't, if people who have certain question marks about the first two effects are actually will generally agree on this third point. And fourth, and very importantly, that they are the complements to countercyclical macroeconomic policies and not substitutes for them. So you cannot, do this and not do anything else to try to avoid a boom or to encourage a recovery in a crisis. Actually, that you use that as in part of a package. And I will conclude by that, saying that the IMF actually issued a couple of years, in 2011, some guidelines. Actually, we propose here an alternative set of guidelines on capital flows. And I think if there is one significant point of difference from the IMF view, is the fact that the IMF had this concept that these are really interventions of last resort. Essentially, you do everything else, and where you don't have any other alternative, you do this. In the view of many developing countries that have used these instruments, if you are going to use them, that's not the way to do it. You actually have to include that in your policy package as part of the instrument that you are going to use. Actually, because, and this is an old report of the IMF from 2000, which is another major report on capital account regulations. That report showed that if you don't have institutions in place, these instruments are unlikely to work. And you cannot improvise institutions. You have to have these institutions in place, and you use them when you need them. So they should be part of a package, and you should use them as part of that package, as a complement to other policies to stop excessive, unsustainable boom, particularly unsustainable financial boom, and then to encourage recovery during the crisis. Okay, thank you.
Well, everyone, it's a great honor to be here and a pleasure, and I appreciate the invitation on behalf of the task force organizers and the hospitality extended by the Pardee Center staff. I think that the current financial crisis has really been a very exciting time for many of us that take a heterodox approach to financial matters. What's been particularly gratifying about the crisis, to the extent that it has some sort of a silver lining, is I think that the crisis has had the effect of achieving something that heterodox economists have really been trying to achieve for a very long time, for about a quarter century at least, and that is that it's actually provoked policymakers in a very large set of developing countries to experiment rather widely with a variety of capital controls. And there are lots of papers, of course, in the task force report that look at the specific attributes of the capital controls that have been utilized by developing countries during the crisis. What I'd like to say is that there are three defining characteristics of the capital controls that have emerged in the context of the crisis. First, what we're seeing is a great deal of heterogeneity in the forms of capital controls that are used both within and across developing countries. Secondly, the capital controls that have been deployed have been utilized in a very dynamic fashion. And what I mean by a dynamic fashion is that the scope and the modality of the capital controls that have been deployed have been adjusted with a great regularity in the context of changes in the global and the national, and in some cases even the regional economic environment, and in response to identified channels of evasion. Thirdly, the capital controls that have been deployed across the developing world have in most cases been utilized as part of a kind of multi-pronged effort to address a diverse set of economic challenges. In some countries during the crisis, and Iceland is of course a very good example, policymakers used controls on capital outflows in order to try to slow the implosion of the economy. There were other countries that also used controls on outflows during the crisis to stabilize the market in response to identified vulnerabilities. And sometimes these were also used in conjunction with a variety of inflow measures. Some countries that have used capital outflows in this context include South Korea, Indonesia, the Russian Federation, Argentina, Ukraine as well. There are also an even larger set of developing countries that have used capital controls in order to address pressures coming on the inflow side to their countries. And I know Kevin, of course, has mentioned Brazil already. South Korea is another example. Costa Rica, Taiwan, Indonesia, Thailand are other examples of countries that have fine-tuned controls on capital inflows in response to identified pressures and vulnerabilities, principally on the inflow side. And these are countries that were really faced with too much of a good thing. And a lot of those pressures, of course, had to do with the multi-speed nature of the world economy, the fact that some countries are recovering a lot more quickly while others are going down the tubes, carry trade activity, currency war pressures. A lot of these pressures have stimulated the use of a variety of inflow controls. What's interesting to me about these inflow controls is that they really demonstrate how policy space is being appropriated and even widened by those developing countries that remain independent of the IMF. And of course, there's another set of developing countries where inflow and outflow controls have been used together during the crisis as a part of a longer-standing commitment to manage financial flows in the service of development. China is, of course, a very good example. Ecuador, another example. Argentina would fit into that category as well. All of the policymakers in this very large set of developing countries that have availed themselves of the policy space that has emerged during the crisis turn out to be very important in terms of reconfiguring policy dialogue on capital controls. What we're seeing is that these increasingly autonomous developing countries are really taking advantage of a new environment, an environment in which the IMF has a very limited geography of influence. That's something that's new. Of course, the academic wing of the economics profession, the official policy community, namely the IMF, have also come around to the idea, in some cases grudgingly, but nevertheless have come around to the idea that capital controls are now a legitimate part of the policy toolkit in the developing world. And I think as each country starts to deploy capital controls with no ill effects on investor sentiment, no downgrades from the rating agencies, no finger wagging by the IMF, it becomes easier and easier for policymakers in other developing countries to deploy capital controls that they also deem to be appropriate. And in that context, I think capital controls have really emerged in the context of the crisis as a kind of new normal in the developing world. Now, one aspect of this autonomy that I think developing countries are increasingly enjoying is their ability to resist any effort on the part of the IMF to try to kind of take back some of the policy space that's been created. The IMF has tested the waters on this regard during a few moments during the financial crisis. Various IMF staff, even some participants in G20 conferences as well, have tried to really take control of the dialogue on capital controls and to suggest that a kind of code of conduct, a set of rules about the appropriateness of capital controls might be articulated. What's been, I think, particularly exciting is that Brazil and other countries in the G24 have unequivocally and very publicly resisted giving any such role to the IMF. And I think it's also the case that the IMF's position on capital controls is becoming increasingly irrelevant as more and more developing countries start to push the boundaries of policy space in order to either introduce or fine-tune controls without waiting for permission from the IMF. And so in my view, I think what's really critical is that these efforts that have emerged during the financial crisis to expand policy space be maintained, and that the recognition that developing countries have the right and indeed the obligation to experiment with a variety of financial measures that could promote financial stability, economic development, enhance their policy autonomy, enhance their control over the exchange rate, that those measures continue to be put forward by policymakers in the developing world. I do want to acknowledge that, of course, I don't want to be read as going too far in assuming that all developing countries enjoy this policy space, and even that all developing countries have responded to the same set of challenges by using capital controls. Of course, there are a number of developing countries that have not responded to the pressures that their economies are under because of all the capital inflows. They have nevertheless rejected capital controls. Turkey is an example of such a country. Chile, Mexico, other examples. Colombian policymakers have also more recently taken a public stance about not using capital controls, but rather have used other measures like currency market interventions, increasing the purchases of dollars, and other measures that are designed to address some of the consequences of large capital inflows without utilizing capital controls as some other countries have. And these kinds of divergences have a lot to do with differing political economies. In some countries, these measures are still not palatable or acceptable. In some countries, neoliberal ideas still have a much greater sway than other countries. And certainly, the continued appreciation of currencies like the Brazilian real may also be giving some policymakers some pause to say that even in the presence of vibrant capital controls, there's still a great deal of pressure on some countries' exchange rates, and that might also be causing some policymakers to take a look at whether capital controls alone are sufficient measures. It's clear that these unilateral measures, I think, aren't alone sufficient to deal with the kinds of pressures we're seeing in the current environment. But in the short run, I think the strategies that have been employed by a number of developing countries have had effects, and we've seen this in the empirical literature. There's very good evidence now when we look at Brazil and many other developing countries. I know Kevin's done some econometric work along these lines. We can see that these capital controls have had notable effects in addressing the kinds of problems that they've been designed to address, at least to an extent. I think it's also the case that the use of capital controls in so many countries is helping to solidify what I think is becoming a growing international sentiment against unregulated capital flows and against light-touch financial regulation more broadly. I think the crisis itself is very productive in the sense of exposing the dangers associated with light-touch finance, with unilateral policies, and a unilateral approach to dealing with financial instability in the developing world, let alone in wealthy countries as well. We may be starting to see signs of common ground emerging. Many countries in the global north are starting to face some of the pressures that countries in the global south are starting to face. It's been really interesting to see the way the Swiss central bank has responded to pressures on the Swiss franc in a country which has so long taken a hardline stance against intervention in monetary matters in general. And so we may be starting to see the emergence of some common ground in parts of the global north and parts of the global south about the need to think about coordinating responses to international capital flows because unilateral actions alone are clearly not sufficient. I'll just close here by noting, I know Kevin is going to be talking about the issue of coordinated strategies of the current environment. I think any regime that we might think about putting in place that seeks to coordinate capital controls across the developing world really has to take very seriously the need to preserve policy autonomy in order to make continued fine-tuning on both the inflow side and the outflow side possible in the developing world. And so I think a fundamental challenge for any new set of policy initiatives is really how to preserve and indeed maximize national policy space for experimentation in order to try to both maintain the policy space that has opened up in larger developing countries, but also to think about ways of extending this policy space to less autonomous states in the global south. And of course, there are a great many of them. And for those countries, it may be the case that thinking about initiatives on, in terms of capital controls on the sub-regional level or on the regional level may be much more promising. The kind of solidarity that we're seeing emerging among the BRIC countries and the BRIC summit, which is coming up at the end of this month, may be for discussions of capital controls, particularly in the context of those countries that have less policy space than the larger ones that many of us focus on. Thank you.
I'll make a final set of remarks picking up from where Ilene just ended and actually argue that we have the perfect regime for countries to have national autonomy to deploy capital account regulations on their own, and for countries to cooperate around the world. And that is the IMF's Articles of Agreement. However, I will also argue that for some countries, not the full 200, but for 50, 60, 70 of them, that freedom that we have under the International Monetary Fund's Articles of Agreement is becoming encroached upon by a number of trade and investment treaties from the United States and the European Union in particular. From 1944, or from March of 1947, when the IMF actually started its operations, until the 1980s, the world economy had this somewhat perfect regime in terms of governing global capital flows, where countries were free to deploy capital account regulations, and they actually cooperated across borders on them throughout the entire period. Article 6 of the Articles of Agreement of the International Monetary Fund explicitly says that members may exercise such controls as are necessary to regulate international capital movements. As a matter of fact, this is one of the things that Harry Dexter White, the lead negotiator for the United States, an economist who got his PhD writing about capital flows and capital account regulations at Harvard, and John Maynard Keynes, who was one of the lead negotiators for the United Kingdom. They argue, there's all sorts of books written about all the things that they argued about. One of the things that they saw eye to eye on is on the regulation of global capital flows and on the need to regulate them on what they called both ends, meaning regulate them at the source of the capital flow and regulate those where the capital flows were among inflows. And this occurred throughout the period until about the 1980s. France in the 1970s was receiving lots of capital inflows, causing appreciation and asset bubbles in the country. They had capital inflow regulations, but they also pressed the United States to maintain our capital outflow regulations. We had regulations on outflows of capital up until the 1970s, and we agreed to maintain our regulations on capital outflows, and it asked Germany to tighten its regulations on capital outflows to help them out, and the two countries worked that out, and Germany tightened its capital outflows as an example. Beginning in the 1980s for a number of reasons, because of new thinking in macroeconomics, because of the vibrancy of global capital markets and the interest groups that come along with that, the IMF started to change its tune on this and actually tried to repeal the Article 6 of the Articles of Agreement and require that nations liberalize their capital accounts as part of their membership to the International Monetary Fund. But as Ilene and Jose Antonio have both noted, because of the role of capital flows in the demise of the East Asian nations in the East Asian financial crisis in the 1990s, and the role of capital flows in the current crisis, the IMF has really changed its tune. We had a National Bureau of Economic Research major study that showed that capital account regulations on inflows are highly effective. And in February of 2010, the International Monetary Fund confirmed those findings and also found that those nations that deployed capital account regulations as the crisis hit were among the least hard hit from the crisis. And since then, they've actually been actively, in some cases, promoting capital account regulations during their surveillances and actually requiring them in some of the standby agreements, as my students over here know because they read every single one of them. During some of their surveillances and consultations with countries, they told Brazil and India that they should increase their regulations on inflows. And in their standby agreements with the Ukraine and their standby agreement with Iceland, they actually required that there be, or approved at least, that there be regulations on the outflows of capital. As Ilene said, in the wake of the crisis, there's been a whole host of countries that have not been part of a standby agreement, but that have been using the sort of the policy space under the Articles of Agreement to their benefit. There's been taxes on bond and stock markets and derivative transactions in Brazil and South Korea. There's been minimum stay and reserve requirements in Taiwan and Indonesia, and outright restrictions on entering stock markets and currency trading altogether in places, except for in pilot projects in places like China and Vietnam. What characterized this moment is that the entire burden of regulating capital flows has fallen on the recipient country, which is actually quite remarkable. Right? We have the peer-reviewed econometric evidence shows that this is working to a certain extent, but without any cooperation like we had during the period from the 1940s up until the 1980s with the developing countries and the northern countries that are the source of the capital flows. In our report, we argue that the IMF could play a strong role in facilitating the cooperation and monitoring of capital account regulations across countries. Indeed, they hosted the French and the German in the United States in the 1970s as a forum when they hammered out some of this agreement. While a number of countries are taking advantage of this policy space that they have under the Articles of Agreement, those are being chipped away at somewhat unconsciously through a host and web of international economic integration agreements and trade treaties. To become a member of the OECD, you now have to commit to opening your capital account. Now, it isn't such a big deal for many developed countries, but now the countries like Chile, Mexico, and South Korea, and Turkey, right, have joined. That's become a bigger issue. To become a member of the European Union, you have to commit to an open capital account. But to those two agreements' credit, there are safeguards and exceptions for crises and managing crises. What's worse is that there are a number of commitments under financial services, under the General Agreement for Trade and Services at the WTO, and a number of United States and European Union, less so on the European Union side, trade treaties that fundamentally restrict the ability to regulate cross-border capital flows, and those are an increasing concern. Under the General Agreement of Trade and Services, that's one of the many treaties under the WTO. This part of those regulates cross-border trade in financial services. And this is one of the only plurilateral components of the WTO. Countries can choose whether or not they want to liberalize financial services in their country. Do they want to allow foreign banks to come in? Do they want to allow cross-border trade in financial services? If a country decides to list or liberalize its financial services commitments under the WTO, they have to allow cross-border flows of capital in and out of a country freely and without delay. The WTO, however, does have a balance of payments exception and a prudential regulation exception that is debatable about the extent to which the kinds of countercyclical regulations that we're talking about could make it through. But they're additionally buffered by the fact that disputes are settled under the World Trade Organization in what's called state-to-state dispute resolution, meaning that nation states get together when there's a concern that one country is violating the agreement, and nation states have to decide on whether or not that they're going to take another country to the WTO for a violation. And it's more often than not the case that a nation state has to decide which cases they're going to go for. Can they win it? Is it going to be politically troublesome with their trading partners and so forth? Did we just slap 14 different suits against the Chinese in the past week? Maybe we should give them a week off, kind of thing. And then when you've got a financial crisis and you're trying to deal with financial flows, it might screen some of the more egregious kinds of cases relative to the kinds of cases that we have on airplanes and pork and things like that. But when it comes to bilateral trade treaties and free trade agreements, especially those by the United States, the tables turn a little bit. U.S. trade treaties, starting from the Central American Free Trade Agreement, require, and our bilateral investment treaties that go back into the 1980s, they require, both in their financial services chapters and in their investment chapters, that capital in all forms, derivatives, foreign direct investments, stocks, bonds, and so forth, in all forms, be able to come back and forth between the countries in the trade treaty freely and without delay. Meaning that essentially you have to liberalize your capital account, at least for the different countries that are part of that treaty. So if you put a tax like Brazil has on bond trading, that would be a violation of the agreement. If you decided to have a regulation on the outflows of capital like South Korea did, that would be a violation of the treaty. And what's different in the U.S. case, and increasingly in European Union treaties, is that the disputes are not settled among states, that a private investor has the ability to directly file a claim against a trading partner's national government and sue them for damages. This sort of changes the cost-benefit analysis that is sort of embodied in the dispute settlement, right? If you have a World Trade Organization, you have a state that is weighing costs and benefits for the national welfare of a country when it's thinking about filing a dispute. And so they might say, well, the benefits of preventing a crisis in a partner country that might have contagion into my country outweigh the cost to a couple small firms that were speculating on another country's currency. All right? That gets tipped in the opposite manner when you're dealing with investor-state disputes, because the one actor that bears the cost makes that decision by directly being able to file a dispute against an actual government. So this is a big concern. What's interesting is that Canadian and European Union treaties have ample safeguards, I wouldn't say ample safeguards, but they at least have safeguards for prudential regulation and for balance of payments. And so what we have for the handful of countries in the developing world that are parties to some of these treaties is a complex web of regulations on global capital flows that are very difficult for countries to really manage capital flows and make it harder for them. For instance, if you're a country like Colombia now, not picking on your great country, but Colombia now has a trade deal with Canada, has a trade deal with the United States, and has a trade deal with the European Union. The trade deal with the United States says that you cannot have any regulations on capital flows in between the United States and Colombia. The Canadian trade deal with Colombia says, well, back in the 90s, you had this really sharp finance minister who had put in place a piece of legislation that says that you can use capital account regulations when you see fit. You cannot regulate global capital flows unless, when you see that law, when you decide under your own accord that you want to use that law. The Europeans say, well, we're not going to go as far as those crazy Canadians, but we are going to have a prudential exception and a balance of payments exception that under concerning situations that you can do that. So that creates an incentive for investors to use their U.S. subsidiary to do their cross-border transfers of capital to Colombia through the United States. So it creates a poor web and loopholes in the ability of countries to be able to regulate. Last week, the United States negotiators just got back from negotiations for a Trans-Pacific Partnership Agreement, which is Chile, Peru, New Zealand, Brunei, Australia, Singapore, Vietnam, and Malaysia. And the United States has on offer to these countries these same kind of provisions that we have under the United States-Colombia Treaty. And 100 economists last week signed a letter informing the negotiators of all these countries about the new economic consensus on capital account regulations and urging them to allow this treaty to have the flexibility for countries to be able to prevent and mitigate financial crises. And the casts of economists that are in there, we had folks from Malaysia, from New Zealand, from Australia, and so forth, but many people that you wouldn't expect to be the usual suspects from the United States signed. Jagdish Bhagwati was one of the first signers of the petition, and he's got to be the most one of the most prominent trade economists, and certainly one of the biggest promoters of free trade. But on this particular issue, he thinks that that liberalizing the capital account while liberalizing trade might not be a good thing. We also have a number of the core people at the Peterson Institute for International Economics, which is also usually very very supportive of trade deals in general, but concerned about these particular provisions in them. I don't want to take away the fire here, because there is a new consensus in the economic profession and among many of the developing countries, and they actually have the International Monetary Fund's Articles of Agreement as their sort of safety in international law. There's a smaller group, maybe 20 to 40 countries, that cannot use the kind of regulations because they've either listed liberalizing financial services under the World Trade Organization, or because they have a trade deal with the United States. But that's a small group. A country like Brazil is not a member of the EU, of course. It's not a member of the OECD. It doesn't sign free trade agreements or bilateral investment treaties as a matter of policy. And it is a member of the WTO. It has one of the most liberal trade regimes in the world, but it has not listed the liberalization of cross-border financial services under the WTO, and therefore has a lot more policy leeway relative to other countries in the world economy. So a couple quick policy recommendations before I open it up for questions and answers. One of the things that we think is essential through the task force is that there needs to be more cooperation among industrialized and developing countries on cross-border capital flows. And there's a real alignment of political and economic interests that really needs to be sort of highlighted and acted upon. Right? We have low interest rates in the United States and in part in Europe to try to generate investment into productive economic activity and employment-generating activity in the United States. I would argue that the intent for the low interest rates is not for hedge funds to be able to buy dollars in the United States and then take them into Brazil, where they can get an interest rate spread of 11% and then bet against the dollar, bet for the Brazilian real, and make billions of dollars. I mean, that's not the idea of these of the regulation or of the low rates. The Bernanke and the administration is trying to generate investment in the United States, but a lot of it is leaking out. It's spilling over into the developing world. Equally, the developing world is trying to maintain their recovery from the crisis, and they're not looking to generate asset bubbles, interest, inflation, and currency appreciation. So there's a means for cooperation, and you see countries like Germany and Brazil getting together, and perhaps we'll see more. The second policy recommendation that comes out of this is that if you are a developing country like Brazil that has the full policy space to regulate capital flows, you should keep it. You should be very critical about a new U.S. proposal to create a club of 15 countries to further liberalize financial services. You should be very critical about a trade deal from the United States or the European Union that requires you to liberalize your financial services sector and makes illegal cross-border regulations for capital. May I talk, since I'm at the Pardee Center, and the core idea about this was to deal with some of the longer range issues? Can I
Of course, by the bus.
go there? First of all, Pardee Task Force reports are, the intent is not to, we try to take small things that have very long-run implications, but not try to solve problems of global inequality in the 1% in one report. But we argue very centrally, and I guess I didn't accentuate it enough in my opening remarks, so it's my fault, and that's why I'm sticking my nose out first, is that dealing with short-run capital volatility is an essential policy that you need for long-run economic development. All right, let's take the Brazilian example that we have right now. Over the past year and a half, they've had about a 42% appreciation of its exchange rate, right? Since the 1940s, their mission of their economy has been to diversify the economy away from coffee and bananas, okay? And they've been relatively successful. Probably every airplane that a number of you that have been on in the past year has been a Brazilian airplane. They are among the world's best ultra-deep oil drillers in the world economy. They've diversified their economy in a significant way, and we know from the peer-reviewed literature on economic growth that the more diversified your economic sectors are, the more long-run growth that you'll have. Okay, so these very short-run fluctuations, when you see Brazilian exporters not able to export in the world economy, that can erode that fundamental diversified mix that the country has for long-run growth. You can see you could see, if it got accentuated, you could see whole sectors fall by the wayside. And that's why the industrial capitalists, and I'm doing a study on Brazil's capital account regulations now, and the industrial capitalists in Sao Paulo, which are the longest-running capitalists in the Brazilian economy that usually support right-wing political parties, actually put pressure on this Workers' Party government to put in place capital account regulations, and every time when she did earlier this week, they're sending press releases and making sure they get quoted in the press to support this, because they need some sort of a macroeconomic cover to be able to maintain the microeconomic gains that they've been able to have for the long term to diversify their economy. So diversified growth is important, and short-run fluctuations and sort of violent attacks on your country can step you up and make it harder to get on that path. And so we see these as vitally connected. And we're just taking a small bite out of it. It took, it's a big report about a small set of regulations, but these small set of regulations have been shunned. And we're trying to help policymakers and think about some of the new consensus that you find in academia and among some of the developing country capitals that we see. I don't know, I spoke too much. Either comments on that?
Happy to.
On the long run? Long run?
Do you want to? I'm happy to. We both can. Oh, all right.
Ladies first.
Okay, ladies first. Okay, good. I think it's a really interesting question about the long run issues that are raised by the report in general. I think that there are a lot of long run implications that motivate the study, our individual contributions in the study collectively. I mean, what we've been seeing just over the last 2 years are a set of developing countries that are initially facing too much of a good thing, then the reversion of capital back to the U.S. as a kind of safe haven, ironically, and in the last few months, capital going back in very large volumes, especially to Latin America. What that indicates is something which we all know, which is that capital flows are inherently volatile. And if we don't kind of wrap our minds around both the short-run challenges posed by whether they're excessive inflows to developing countries or the problem of excessive outflows, what we're going to see is this constant buffeting of developing countries that face either the continued challenges of currency appreciations, which may not be welcome, and also capital flight that leads to currency depreciations. So even though many of the responses that developing countries are articulating at the present time are designed to really resolve immediate challenges, I think of them as also part of a larger process of creating a kind of capacity to manage the volatility of capital flows that they're going to continue to see both in the short, medium, and even in the long run. One other issue, I guess, that I wanted to raise in terms of longer-term strategies that gets a little bit outside of the scope of this report, but I think is not inconsistent with the report, is that the kinds of arguments that I think motivate all of us that are looking at the issues of managing international capital flows are part of a kind of broader interest that we have, a longer run interest in developing countries, and that is what are the best ways to utilize the financial sector in the service of economic development? What are the strategies by which capital can be mobilized and allocated in order to address problems of inequality, instability, low levels of productivity, et cetera, all of these kinds of problems. And so I think capital controls are a small piece of that broader kind of Keynesian agenda, which is to say, how do you get finance to work in the service of the real economy? And so in that sense, I think of this project as being part of that much larger issue. One other point. About power, because I think you also raised an interesting point about the 1%, the Occupy Wall Street movement. I think we could also think about capital controls not just as we do as economists to say, okay, how do they promote things like policy autonomy and financial stability? But the ability to regulate international capital, I think, is also part of a way of thinking about shifting power in the global economy toward industrialists, toward wage earners, towards policymakers, and away from international financial actors. And so to the extent that we think about capital controls as a kind of mechanism of enhancing political voice of groups which are largely disenfranchised around the globe, I see it as part of a larger political project. I think you really raised some fascinating things.
Why coordination? I think there's probably, first of all, because there is a huge asymmetry in the international system in terms of the size of the markets. According to my estimate based on BIS data, the markets for securities of all emerging markets together is only 11% of the global market. So a thing that happens in the global market, the U.S. has, I don't know, something like a bit more than a third of that market worldwide. A thing that happens, so it's like 3 times the emerging markets together. So anything that happens in this part will have immense repercussions in other parts of the world. Now, so from that point of view, the effectiveness of any regulation on the receiving part will be significantly enhanced if it was supported by a regulation on the other side. You may say, what does the UN gain from coordinating that? I would say, well, it may actually support its own recovery. It may actually, keep capital at home. That is, Kevin's suggestion in his presentation. So it may be good. Of course, given the asymmetries in size, the U.S. In a sense has probably less to win by coordinating than what the Brazil, let's say, will win by that coordination. But part of the ineffectiveness of regulating finance, as we well know, are the loopholes in the system. The ways you can actually escape the regulations. And this is a point that is central to the debate on regulating finance. Even in the United States. What is the how by regulating banking, everything gets distorted because it goes to the non-banking sector, the shadow banking as it is called today, so that either you regulate you expand the frontier regulation to be able to have an effective system or not. This is the same, in a sense, the same argument to have coordination worldwide. But I would say, let's say, from a developing country perspective, I think developing countries have the right to ask the U.S. to support regulation, because otherwise it may be difficult actually to have an effective system in place. And I think that's part of the tragedy of all these systems, that you try to. I mean, well, using Dilma Rousseff's expression of a tsunami. Many countries, and particularly Brazil, because Brazil is actually particularly bad. I mean, one of the characteristics is that when you have these floods of capital, they will look first of all the markets that are attractive. And what are the markets attractive? The markets that are large and liquid. Okay. Now it just happened that Brazil has a huge market, which is very liquid for instance, for treasury bonds. So it's a very liquid market. And the same thing is Korea. So it's not surprising that those two countries have been where a lot of instability has been generated by this tsunami of capital.
If I could speak to the cooperation component, because I want to be very clear that in my particular essays in this report and in my presentation, I am talking about cooperation, and I'm actually not. I don't think coordination is a great idea, and that there's a distinction, and there's some other folks in the task force that are really for coordination, and I draw the distinction in the following manner. Cooperation is more analogous to the France, Germany, U.S., right? You have all the policy space, and you're getting pummeled by inflows, and you realize that it's coming from the United States and it's coming from Europe. And so in this past week, the president of Brazil has been talking to the Germans and talking to the United States and trying to cooperate. He's saying, hey, we can't handle this tsunami. And we're doing these kinds of measures, but a 6% tax on bonds is only going to last us a month before your investors figure out how to week around it and so forth. And so you folks have to have your own analogous set. And so cooperation is something that that is important, that had went on from the 40s into the 70s, but it's been difficult. And you say, well, why doesn't the United States act in its interest? Well, it might be in our national interest, but political economy makes it much more difficult to make it happen. I mean, we have the low interest rates to try to get investment going in the United States because Ben Bernanke is one of the last non-austerity economists in the United States administration that can do anything. That the other policies, any kind of outflows tax or something like that, would be fiscal. That would have to go through Congress and so forth. And if you don't already have that on the books the way Colombia does, the executive branch can't just turn on some sort of regulation like that. And you could never get something like that passed through the U.S. Congress, which is why it's so hard. But let me. There's Arvind Subramanian is one of the members of the task force, and in his contribution, he does strongly advocate for coordination. And as a matter of fact, him and Olivier Jean are coming out with a book called How to Regulate Global Capital Accounts, which they summarize here. And he says that there should be some sort of a hierarchy of when and how you should use capital account regulation, somewhat similar to the IMF guidelines that some of us have talked about. And that set of guidelines should be, that we should set up a global institution that is WTO-like, that regulates global capital flows. So get capital flows out of the WTO, have a global trade-like regime just for capital flows, have a certain set of guiding principles for when you can use regulations and when you shouldn't. And if countries are getting adversely affected by your regulations, then they could take you to this new body, and the way you could be taken to the WTO. So that's where I shouldn't say that everyone has perfectly consistent sets of regulations, recommendations. We all came together and talked about this stuff for a whole day. That's his recommendation. He also would argue, and I think Ilene mentioned this a little bit in her presentation, that sometimes regional solutions and regional coordination can also be important. Say you've got a case where right now Brazil and Argentina both have regulations on the inflows of capital. And so they're doing a decent job of keeping that out. But poor Uruguay next door, for one reason or another, doesn't have those regulations, and perhaps they might be getting pummeled. And so maybe there should be something like a Mercosur action, so that Paraguay and Uruguay don't get hit by all the capital. So some people say we should have coordination. What I'm focusing on, I think there should be cooperation. And the Brazilians right now are her tour of the world right now, one of the core things is sort of begging developed countries to cooperate, not necessarily coordinate.
Can I jump in on that as well? Do you mind?
Yeah, one more jump in on
Oh,
that.
okay,
No,
just,
go
it's
ahead.
an interesting issue about this distinction between coordination and cooperation. I've got to think analytically about that distinction, because I tend to conflate them both, and argue that coordination on capital controls is important going forward. I think there are a couple of things to be accomplished by moving forward on coordinating capital controls, at least creating a mechanism wherein they could be coordinated. One is to prevent policy conflict. I mean, we're seeing policy conflicts among developing countries right now precisely over issues that are raised by the international capital flows. For example, there's a lot of tension between China and Brazil right now, which is interesting because they're the two big players in the BRIC countries, and Brazil keeps threatening to take China to the WTO on charges of currency manipulation, which of course falls outside of that institution's portfolio, which just kind of underscores the inadequacies in the financial architecture, the trade architecture of the world, that there is no place for these kinds of discussions about how to deal with policy conflicts when it comes to the spillover effects of capital flows. And so I think preventing these kinds of, or minimizing these Stackelberg warfare kinds of issues are important. Other things that I think could be accomplished by coordination of capital controls is that any individual country might be able to have controls that are less stringent if their policies are in some way coordinated with other countries, and so that there's less burden on an individual country's policy to do all the work if there is some coordination. And so I think that's another aspect of this discussion that's important to me. Other things, sharing expertise and experience on best practices, how to close channels of evasion, that can come up in the context of dialogue and coordination among developing countries. For smaller countries, coordination may be a way of pooling and enhancing sovereignty. And so it may not be that important for the big developing countries to coordinate, but when you're talking about small countries that have limited bargaining power, if they're going to play with larger players, maybe the only way they can do that effectively is if there is some mechanism for policy dialogue amongst them and policy coordination. And I think the IMF, just the last point I'd make, the IMF has kind of come around to the idea that coordination and an analysis of spillover effects is important. I think that's something that's positive that's come out of the global crisis, that the IMF has now taken on the role of writing these spillover reports, which seem like something that institutions should have obviously done years ago, but now they're actually having to think through, in the context of Article 4 discussions, what are the spillover effects of one country's policies on another. Granted, they're not always doing that consistently because they're curiously silent on the spillover effects of U.S. monetary policy on other countries, but I think there is some recognition even at the fund that we've got to look at policies in a more integrated fashion, and that also, I think, helps us to think about why some dialogue and coordination may be important.
To say that you actually want to change behavior. I mean, that's exactly what this is about. And why do you want to change behavior? Because you think that why do you want to regulate finance? And because there is a perception that, first of all, that there is a bad evaluation of risk by private actors during booms, and that evaluation has social implications. Because that is what generates the crisis. And that's why you want to regulate. So you actually want to change behavior. And in particular, in this case, you want to avoid these tsunamis of finance coming to emerging markets, which is very similar to, let's say, to a financial boom like that you experienced in the United States prior to the financial crisis. And you want to do that because there is an underestimation of the risk involved, which in developing countries we know very well. from past experience that you try to absorb that capital, you essentially get indigestion, you know. And how is that reflected? It's reflected in the fact that you accumulate, you change, you increase your current account deficit. You end up importing in an import boom, and that at the end becomes the very source of the crisis later on. Because at the end of the boom, you have a huge external deficit in your current account that is financed by the capital inflows. Then when capital stops in, then you have to adjust, and the adjustment is very painful. And that's exactly why you want to. So you actually want to do this for the basic two reasons: that risk is badly evaluated by private actors under some circumstances. I mean, some risk is very well done, and you should have a well-functioning market to manage risk. But some risks are done badly by the private sector. What is worse is that all of us pay for the bill.
Sure. Yeah, I think the risk-return calculus question is an interesting one. Of course, I agree with Jose Antonio's response on this, that the goal is precisely to change that calculus. I think it's also the case, as I would just add to that, that capital controls that are well designed may actually reduce in risk to investors to the extent that they make developing country economies less prone to the kinds of crises that can cause investors to experience massive capital losses. It could mean that to the extent that they promote stability in the developing world, developing countries get more access to capital as investors come to see those environments as less risky. That's something that I'd like to see investors think about, and perhaps the fact that the credit rating agencies haven't downgraded developing countries recently for using capital controls suggests that even the rating agencies actually recognize that some kinds of capital controls may actually be in the interests of investors.
And there is definitely a big rationale in certain parts of economic theory that would justify your remarks, right? The new classical macroeconomics and the efficient market hypothesis would say, hey, markets are the smart ones out there, and if Brazil's getting too much investment, then they should get down on, they should be put on their knees, and finally markets will automatically correct that. I would say that the economists that are in this task force have a different theoretical framework that comes from probably two different schools in general. One would be what, if you're studying with Professor Carline, probably understand a Walrasian framework, that neoclassical economics, there's a new welfare economics of capital account regulations that's being developed by economists named Anton Korenek in Maryland and Olivier Jean at the Peterson Institute, that sees unstable capital flows as a negative externality into a developing or into a country, and that capital account regulations are market correcting a distortion from the externalities. And therefore, there's from a neoclassical economics perspective, there's a real market failure rationale to have capital account regulations, just like you might have with pollution, right? Is that you've got externalities out of pollution. It makes sense to put a tax on the amount of cars that are produced, because the car production in the Midwest in the United States doesn't incorporate the economic costs from acid rain that you'll find in farms in New Hampshire. Sort of same kind of idea. Another, not to summarize the whole group of 12 people in here, but then there's another strand that would be called a Keynesian or post-Keynesian or even new Keynesian perspective that says that markets are sticky and imperfect, and that there isn't a unifying theory for the entire economy, but that economic actors and policymakers should be using tools to try to promote economic growth and employment, and that's sort of where a Keynesian would come from on this, and there isn't so you could argue against our things from a new classical economic perspective, but we've got arguments against you.